90% of the world's electronics don't need a cutting-edge chip. Let that sit for a second. The semiconductor war that has consumed Washington's foreign policy attention triggered $52 billion in federal subsidies, reshaped U.S.-Taiwan relations, and led to the most aggressive export control regime since the Cold War. It's being fought over the 10% of the market that needs leading-edge nodes. The other 90%? Nobody in Washington had a serious strategy for that. China did. Here's the contradiction that should reframe everything you've read about this topic. The United States is winning the technology race and losing the industrial war simultaneously. TSMC can manufacture 2-nanometer chips. ASML's next-generation high-NA EUV machines cost $380 million each, and China cannot legally buy them. American AI chips, NVIDIA's H100, the Blackwell architecture, are generational leaps that Chinese fabs cannot replicate. On paper, the U.S. holds every card that matters. And yet, in 2023, China's share of global mature node wafer capacity, chips made at 28 nanometers and above, crossed 31%. By 2027, the Semi-Industry Association projects that number reaches 39%. Not because China got lucky, because China made a decision about 6 years ago that Washington still hasn't fully absorbed. The company that controls the boring chips controls everything that depends on them. Your car has somewhere between 1,400 and 3,000 semiconductors in it. The overwhelming majority are mature node chips, 40 nanometers, 65 nanometers, 90 nanometers process technology that was considered unremarkable a decade ago. Same story for your washing machine, your industrial motor controller, the power management unit in your laptop, the radar altimeter in a commercial aircraft, the microcontroller in a hospital ventilator. None of these need 3 nanometers. None of them ever will. But all of them need to exist reliably in volume at low cost, and increasingly, they need to come from somewhere. China noticed the somewhere problem before anyone else named it. Between 2020 and 2023, Chinese semiconductor equipment spending on mature node capacity expansion was, by some estimates, the largest single capital deployment in the history of that technology tier. SMIC, Hua Hong Semiconductor, Nextchip, Cyan. These aren't household names in the Western press. They've been quietly building out 28 nanometers, 40 nanometers, and 55 nanometers capacity at a pace that the rest of the world's foundries simply aren't matching, partly because the margins on mature nodes are thin, and private capital doesn't love thin margins. State capital does. This is where I had to stop and sit with something uncomfortable. I've spent a fair amount of time convinced that China's semiconductor ambitions were fundamentally constrained, that without EUV access, without the advanced process nodes, without the Cadence and Synopsys EDA tools they've been partially cut off from, the ceiling was low. And on the leading edge, that's still true. But the leading edge isn't the whole battlefield. It's not even most of it. The U.S. CHIPS Act was architected around a specific theory of victory. If you control the frontier, you control the future. Invest in 2-nanometer fabs on American soil, restrict China's access to the tools needed to get there, and the gap compounds over time. That logic isn't wrong. It's incomplete, because while Washington was drawing the map around the frontier, Beijing was buying up the territory everyone assumed didn't matter. There's a number I want you to hold on to. We'll come back to it in a way that reframes the entire subsidy argument. It's $30 billion. Remember it. The 28-nanometer node turned 15 years old recently. TSMC First Risk produced it in 2010. By the standards of semiconductor discourse, where the conversation is always about the next node, the next breakthrough, the next angstrom-scale miracle, 28 nanometers is practically ancient. It should be a footnote. Instead, it became a choke point. To understand why, you need to understand something about how chip demand actually distributes across an economy. Leading-edge nodes, 3 nanometers, 5 nanometers, 7 nanometers, serve a narrow slice of applications. flagship smartphones, data center AI accelerators, the most power-sensitive compute workloads. The companies buying these chips are Apple, NVIDIA, AMD, Qualcomm, a handful of hyperscalers. The customer list is short. The volumes, relative to the broader chip market, are modest. The margins are extraordinary, which is why TSMC charges what it charges and why investors love the leading-edge story. Mature nodes serve everyone else. Automotive electronics, industrial automation, consumer appliances, medical devices, power semiconductors, RF components, analog chips, microcontrollers, display drivers. The entire physical infrastructure of modern manufacturing runs on chips that were designed at process nodes nobody is writing breathless headlines about. And the demand for these chips is not shrinking. It's accelerating, driven by electrification, by the expansion of IoT devices, by the industrial automation wave that every major economy is chasing simultaneously. So here's the mechanism China exploited, and it's almost elegant in its simplicity. Mature node fabs are cheaper to build than leading-edge ones. A 28-nanometer fab costs somewhere in the $3.5 billion range to construct, versus $20 billion or more for a leading-edge facility. The equipment is available, much of it not subject to the export controls targeting advanced semiconductor manufacturing. The process technology is well understood, which means yield rates are high and manufacturing risk is low. And crucially, the end markets are enormous, price-sensitive, and would switch suppliers the moment a cheaper, reliable alternative appeared. China built the alternative. The human anchor in this story isn't a ministry or a 5-year plan. It's a company called Nextchip Semiconductor, headquartered in Hefei, a city in Anhui province that has systematically positioned itself as China's semiconductor interior hub. Nextchip was essentially unknown outside Chinese industry circles until around 2021. By 2023, it had become one of the fastest-scaling display driver IC foundries in the world, operating at 40 nanometers and pushing toward 28 nanometers, with capacity expansions funded through a combination of local government industrial funds and national semiconductor investment vehicles. Its customers aren't just domestic. It has been quietly pulling orders from global fabless companies who discovered that Nextchip's pricing on display driver chips was simply hard to refuse. That's the tell. When global fabless companies headquartered outside China, with no political obligation to Beijing, start routing production to Chinese mature node fabs because the economics work, the strategy has succeeded on its own terms. You don't need to capture the customer through coercion if you've captured them through cost. Now, that $30 billion figure I mentioned earlier, that's the approximate total of CHIPS Act funding directed towards semiconductor manufacturing incentives in the United States. It sounds large. Against the scale of the problem, it has a specific and underappreciated limitation. Almost all of it is being directed toward leading-edge capacity, the TSMC Arizona fab, the Intel Ohio expansion, Samsung in Texas. These are 3 nanometers, 2 nanometers, angstrom-class facilities. They are strategically important for the reasons Washington believes they are. But the CHIPS Act contains no serious, dedicated industrial policy for mature node domestic capacity, the nodes that actually supply the defense industrial base, the automotive sector, and the medical device industry with the chips they need right now. The Government Accountability Office flagged this gap in 2023. The Semiconductor Industry Association has flagged it. Even some of the Act's original architects have acknowledged the omission in subsequent testimony. The leading-edge bet wasn't wrong. The absence of a parallel mature node bet was. China didn't make that mistake. China made both bets, and made them with the kind of capital patience that doesn't answer to a quarterly earnings call. There's a version of this story where the mature node buildup is less threatening than it looks, where overcapacity drives prices down, margins collapse, and Chinese fabs find themselves in a financial trap of their own making. That version exists. I want to be honest about it before I explain why I don't find it convincing. The overcapacity argument is the most intellectually serious pushback against everything I've laid out so far. It deserves a fair hearing. The logic goes like this. China's state-directed capital has flooded mature node manufacturing with investment that no rational private actor would have made. The result is a glut. 28-nanometer wafer prices have been under sustained downward pressure since 2022. Hua Hong's margins compressed visibly in their 2023 financials. Some Chinese fabs are running utilization rates below 70%, in an industry where 85–90% is considered healthy. If you build too much of something the world doesn't need at the price you need to charge, you don't win a strategic competition. You burn money at industrial scale. That's a real dynamic. I'm not dismissing it. But here's the reversal, and it matters. Overcapacity in a strategic industry isn't a bug in China's model. It's the feature. When Chinese solar panel manufacturers flooded the global market with below-cost panels in the late 2000s and early 2010s, Western analysts made almost exactly the same argument. The margins are unsustainable. The subsidies will dry up. The overcapacity will self-correct. What actually happened? The Western solar manufacturing industry was largely wiped out. China now controls roughly 80% of global solar panel production across the entire supply chain. Polysilicon, wafers, cells, modules, and the subsidies didn't dry up. They evolved. The overcapacity wasn't a failure mode. It was the mechanism of market capture, absorbed as a policy cost rather than a financial constraint. Mature node semiconductors are on a recognizable trajectory. Not identical. Chips are more complex than solar panels, the customer qualification process is longer, the switching costs are higher. But the directional logic holds. If Chinese fabs can sustain below-market pricing long enough to become the default supplier for enough product categories, the Western and Taiwanese fabs that once served those categories will shrink their mature node operations, redirect capital toward leading edge, and quietly seed the ground. Some of this has already started. GlobalFoundries has made explicit strategic decisions to focus on differentiated specialty nodes rather than compete on commodity 28-nanometer pricing. That's a rational corporate decision. It's also exactly the terrain clearing that the Chinese buildup was designed to produce. Here's where the data gets specific in a way that should concentrate minds. According to a 2023 Boston Consulting Group analysis, approximately 25% of the chips used by U.S. defense contractors are sourced from mature nodes, and a non-trivial share of that supply chain runs through Asian foundries with no guaranteed access in a conflict scenario. The Pentagon's defense microelectronics activity has been working on this problem, but the honest assessment from people inside that process is that the supply chain for mature node defense chips is undersecured in ways that the public debate about leading-edge technology almost entirely obscures. A 2-nanometer chip in an AI training cluster is strategically important. A 90-nanometer microcontroller in a guidance system is operationally critical. These are not the same sentence. The automobile industry learned this the hard way in 2021. The chip shortage that cost Ford and GM billions in lost production wasn't caused by a shortage of 5-nanometer processors. It was caused by a shortage of 40-nanometer microcontrollers, chips that cost roughly $1 each, manufactured at nodes that were considered too boring to warrant serious supply chain attention. A dollar chip halted a $50,000 truck. That's not a metaphor for the mature node problem. That's the mature node problem, running live, in real time, with a price tag the industry still hasn't fully digested. The U.S. strategic bet on leading-edge nodes assumes that technological superiority at the frontier translates into leverage across the broader semiconductor economy. In some scenarios, it does. In the scenarios that are actually unfolding, automotive supply chains, defense microelectronics, industrial automation, consumer electronics manufacturing, the leverage sites with whoever controls reliable, affordable, high-volume, mature node supply. And that leverage is shifting. I want to be precise about what I'm arguing and what I'm not. I'm not arguing that the CHIPS Act was a mistake, or that leading-edge investment is misallocated, or that China has already won this competition. None of those things are true. What I'm arguing is narrower and more unsettling. The US defined the competition in a way that left an entire dimension of it uncontested, and China filled that dimension with a decade of patient, state-directed capital that is now structural. You can't unbuild 39% of global mature node capacity in a policy cycle. There's a phrase that gets used in military strategy, fighting the last war. It describes the tendency of institutions to build doctrine, capability, and infrastructure optimized for the conflict they just survived rather than the one they're about to enter. The French built the Maginot Line. It was an extraordinary feat of engineering. Germany went around it. The CHIPS Act, in its current form, is a Maginot Line with better marketing. That's not a dismissal. The Maginot Line was built by serious people responding to a real threat with genuine resources. The CHIPS Act is the same. The leading-edge investment is real, the strategic logic is coherent, and the alternative, doing nothing while TSMC remained the sole producer of the world's most advanced chips on a seismically active island 90 miles from mainland China, was genuinely untenable. I understand why the bet was made the way it was made, but strategy is about the full terrain, not the most photogenic hill. And the full terrain now includes a Chinese mature node manufacturing base that has been deliberately engineered to be difficult to dislodge, not because it's technologically superior, but because it's structurally embedded. When your automotive supplier, your appliance manufacturer, your industrial equipment producer, and your defense subcontractor have all quietly qualified Chinese mature node fabs into their supply chains because the price was right and the lead times were reliable, you don't fix that with a subsidy announcement. You fix it over a decade. If you start now with a seriousness of purpose the current policy architecture doesn't yet reflect. Here's my editorial take, plainly. The United States won the definition of the semiconductor war and is at risk of losing the semiconductor war. By insisting that the contest was fundamentally about who could print the smallest transistor, Washington created a framework in which China, blocked from leading edge by export controls, had every incentive to dominate everything else. The controls worked as designed. The strategic perimeter they drew was too narrow. China didn't beat America's chip strategy. China made America's chip strategy irrelevant to 90% of the market it was supposed to protect. The prediction I'll stake on this: within 5 years, there will be a mature node supply shock, not a shortage exactly, but a pricing and access event in some critical product category, probably automotive or defense adjacent, that forces a public reckoning with the gap in U.S. industrial policy that this video has tried to name. When that happens, the policy response will be expensive, reactive, and slower than anyone wants. The groundwork for that moment is already laid. The fabs are already built. The customer qualifications are already underway. The $30 billion bet on the frontier was never going to be wrong. It was going to be insufficient. And insufficiency, in a strategic competition, has a way of feeling like losing even when the technology scorecard says otherwise. One last thing, there's something almost instructive about the fact that the chip everyone ignored, the 28 nanometer node, the one that's been around since the Obama administration, the one that doesn't generate conference keynotes or breathless investor memos, turned out to be the terrain that mattered most: the boring chip. The one in your car door sensor and your refrigerator compressor and your building's HVAC controller. Turns out the future wasn't waiting at the frontier. It was already running, quietly, at 28 nanometers. If this reframed how you think about the semiconductor competition, share it with someone who still believes this story is only about the most advanced chips. Because the most consequential arguments are usually the ones nobody thought to have. Subscribe if you want more of them.